So we're gonna kick it off here. So welcome each one of you to our M&A roundtable this afternoon. And the M&A network is essentially a collection of advisors, trusted advisors that assist companies in their transition or in their business needs. We have strategists that help companies expand, grow, from accounting, legal, everything you name it. That's why we put this here together. One of the challenges I had in my business, I have clients that would come to me that were looking to sell their business, and they have not done any necessary proactive activities to help them plan for that, that liquidity event when they actually sell their company. They need help in so many different areas. So I used to get together with a small group of folks, and I would call some of my colleagues and say, hey, I have this particular challenge with a client, and this is the story, and maybe you can help me out with that. And I used to take that information and bring it back to my client. So as part of our process, we do a complete assessment of the client to kind of see what their value is, when it should sell, and give them our professional opinion if we can service them or not. And as part of that, there's other aspects of the business where it's not our day-to-day services, where we would bring other people in, other advisors in to advise the client and their needs. So that's essentially how this has birthed, and we've built out a pretty nice team, about 30 companies that provide services from marketing to accounting services and so on. So today, the idea with this roundtable is essentially to share ideas and best practices. We usually have a speaker that talks about a topic that's relative to M&A. So we're going to get into that a little bit. So Doug Rowe is going to be our speaker today. He's going to talk about employment law in M&A. And we also have case studies and different things that we do at our roundtables. So before we jump in, I just want to let you guys know we have an event that's coming up on October 8th. We have two CEOs that's been involved in an M&A transaction, one of which was the CEO of Impact Systems, and he sold his company, and we have a buyer that purchased a separate company, Need That Care. So Roy Pelicano, who's one of our IT consultants, he's going to moderate this meeting, this webinar. So I'm gonna put a link in the chat just to make sure you guys can register and attend this event. It's a week from today. And I invite you as well to join our LinkedIn group. We have a public group on LinkedIn for guests who have attended our M&A roundtables and our events, where we could be an extension of this particular conversation. So if you want to reconnect with anyone from here, you can connect with them there in our LinkedIn group. And hopefully at some point we can get a chance to meet in person again. I don't foresee any meeting until probably January. We hope we're working towards having a nice event and get together with all the members and guests and clients and so on in January. So we're looking forward to that. So we're going to jump into the meeting. I think I want to take this time for folks to kind of introduce themselves. You want to take opportunity to tell us about you, your firm, what industries you serve, who's the ideal client for you, so folks can get a good feel for you and your business. So I'm going to stop the screen share, and then once we're done with the introductions, we're going to jump back into our presentation, which is the topic, as I mentioned before, is going to be employment law issues in M&A, and our speaker will be Doug Rowe. But for now, we're going to jump into our introductions, and I want to start first with Andy Jacobs.
Good morning, everyone, or actually good afternoon. I'm Andy Jacobs from Gravitas Marketing Strategies. I'm a 40-year veteran of the marketing wars, having had my own firms. And today I run a consultancy where I act as a strategic advisor to small and mid-market companies. And I also act as the creative and branding specialist to help them actually make some traction in a very crowded and difficult marketplace. My ideal client is a small and mid-market company, let's say anything up to 15 million. They had to have marketed before. I'm not in the education business, and their expectations probably should not have been met. And those are the ones that I can really gain some traction with. I work over the 40 years. I've worked with 2,000 entities, from divisions of Fortune 500 companies to funded startups, B2B, B2C, nonprofit, every vertical, every trade class. Humans are humans. They're all sold the same way. And that's what I do. So thank you very much. Andy Jacobs, Gravitas.
Thank you, Andy. Austin Bransgrove.
Cool. Thanks, Kyle. Nice to have some new faces here today. It's good. So my name is Austin Bransgrove. I'm a managing associate with Rethink Wealth. And in my practice, I basically do three things for clients. So first, I'll do personal financial planning. The second, and the reason I'm here today is part of this group, is I'm a certified exit planner. I do business growth and exit planning for closely held businesses. And so that work is everything, essentially everything that Kyle mentioned in terms of businesses not being ready for the transaction. Those are the pieces that I help make sure are actually done and fit into place and are working well in advance, so that companies are ready to go and sellers are ready to go when it comes time for their exit. The third thing that I do is I help implement plans. And so a lot of times there's elements of wealth management or insurance planning that need to be addressed through the course of planning for the business specifically, or for the personal clients, the sellers specifically. So we'll speak to that and help provide those solutions as well. Clients that I focus on are generally, I said, closely held businesses. A lot of the clients I have are family businesses where there's some dynamics going on in terms of transfers or considerations between multiple generations, parents, children, things like that. And usually the businesses are netting at the end of the year profits in excess of $1 million. Anywhere up to about $100 million of business value is an okay space for me to be in. And generally anywhere from like a 5 to 30 million or so in business value is really a sweet spot in the wheelhouse for us, where there's a lot of good advice that we can bring for businesses and owners who need help and don't get access to people who work with larger companies.
Thank you very much, Austin. Dr. Schaefer, Dr. Dan, you're up next.
Right there. Dan Schaefer, Peak Performance Strategies. I'm a business and sports psychologist. I bring psychology into the workplace, having nothing to do with any of the business stuff, the numbers and the negotiations, but really on the things that cause deals not to happen, that are based on psychological basis. So it has to do with communication strategies. Basically what I tell people is that I sell mistakes and I help people prevent really costly error.
Thank you, Dan. George, if I'm saying your last name correctly.
Licorosis. Took me a while too.
Thanks. Thanks for inviting me. My name is George Licorezos. I'm a partner at Carter, DeLuca, and Farrell. We're an intellectual property law firm based in Melville, but we're an international law firm. And we help clients from startups all the way up to Fortune 100 companies protect their innovations, their trademarks, branding. And on the M&A side, we do a lot of due diligence. Mainly, we get referrals from corporate law firms to look at patents, scope of the IP, whether there's any untapped potential value that can be found. Whether it's brand names that haven't been registered with the U.S. Patent and Trademark Office, corporate names. So we try to find the value before a seller comes in and starts digging around and finds that some of the IP may not be as protected as it could have been. So we make sure that's done. And then on the buyer side, we also look to investigate whether the intellectual property is held by the company that they're looking to acquire or invest in, and whether there's any technology that is yet to be protected that should have been protected. So those are the things we do on the M&A, but we're a full-service intellectual property law firm.
Thank you very much, George.
Thank you.
We're going to move to Jeff Hodge.
Hi, Kyle. Thanks for having me. It's Jeff Hawk from the Culca Group. I'm in week 2 of working here. Excited to be at the new firm. We're a commercial construction firm. done a lot of development and building in the Hauppauge area, Hauppauge Industrial Park. We're also the operators of a platform that we started recently called Culca Interactive. It's a video and content sharing platform for all types of business and market intelligence. And my role in the firm is to work in the capacity of a commercial real estate broker with the slant towards finding opportunities for investment. We're looking to go heavily into the multifamily development space. And we have a lot of opportunities being brought to us by investment groups. So I'm really, looking opportunistically on Long Island and the outer boroughs for cases where we can stand up large multifamily developments.
Thank you very much. Thank you. Jim Vigna?
Yeah, how you doing, Kyle? So Jim Vigna, Live Oak Bank. We're the largest SBA lender in the country. The SBA year just ended yesterday. And for the third year in a row, we're the largest SBA lender in the country. So as banks pulled back on the conventional side, and even a lot of SBA lenders pulled back this year, we kind of pressed on. We found a lot of, the credits even got better this year, with less competition out there. So where we did $1.35 billion last year, we're going to come in at about $2 billion this year. And I don't think any other SBA lender did $1 billion. So we've kind of pressed on this year. It's been a tough year, but a real busy year. And as people, other banks are pulling back, we seem to be plugging along and finding some pretty good deals out there.
Thank you, Jim. Next, we're going to go to Carl.
Thanks, Kyle, and it's a pleasure to be here. Thanks for having me. So in my area, I'm the managing partner of Renovatio Global, and what we specialize in doing is being able to put a magnet on the market by leveraging the value around people, processes, resources, especially with strategic partnerships to be able to grow things and move things forward. Toward that end, we're consulting a number of different companies. One company is looking at a 5-year buyout strategy. Currently, they're in the lagoon management space, but when we dug deeper, we realized that they're really a Disney at heart. They're an innovation company that's not only making things happen within the properties that they're managing, but also for the key technology that has been licensed and impacting 300 locations around the globe and other projects. Because of work that we've done with them, they've recently been approached by a developer to be able to build out about 50 lagoons. And we also took a look at their revenue strategies and are looking at streaming and celebrity influencers, as well as a private access model for being able to help them to bring in another $1 million net revenue on an annual basis per location. So we take a look at the strategic partnerships, the technology, the perception, how branding design can really turn vision into a tangibility, and being able to help the clients to be able to move forward and really get the desired valuations and exit strategies that they're looking at. And then on the other side, I've got a holding in a company that's looking at the documents and the data intersection. And we've been having some interesting conversations with family offices, especially around roll-ups and other areas, and how getting the documents and the data in order is really critical, but there's also a risk transfer that takes place when a merger or acquisition happens, and ways in which to be able to mitigate some of that risk. So it's a pleasure to be with you here today, and I look forward to seeing how to add value to each of you.
Oh, it's been a long time, man.
It has been.
You're kicking ass, man. It's been a while. I'm glad you're able to make it today. So we have a lot to catch up on. So I appreciate your time.
Really appreciate it. Thanks, Kyle.
You're welcome. Next up is Meredith.
Thanks, Kyle. Thanks for inviting me to be your guest today. This is a great group. I'm Meredith Carter. I'm president and CEO of Context Business Lending. I'm a recovering attorney. Before this, I helped grow and sell a litigation funding business and was recruited by the same family office to grow this business. So our clients are lower middle market companies looking for working capital solutions when they're temporarily unbankable. So we provide $1 million to $50 million in revolving lines of credit secured by the assets of the company. So accounts receivable, inventory, machinery and equipment, and real estate. And because we're family office backed, we can get a lot more flexible, for example, on heavy inventory deals and firearms deals and things that for regulatory reasons banks can't handle. Nice to meet all of you.
Interesting. I want to hear a little bit more about that, Meredith. So looking forward to connecting more with you later on in the meeting, okay?
Thank you.
Thank you. So next up is Nelson, Mr. Nelson Tepfer.
Yeah. Good afternoon, everyone. Nelson Tepfer. I'm the managing partner of Pro CFO Partners, where I lead a team of more than 20 CFOs in providing part-time CFO services to companies that don't need, don't want, or cannot afford a full-time CFO. Most of the time it's don't need. Both myself and every member on my team have been an actual CFO before. Our clients range from funded startup pre-revenue to our largest clients are about 300 million in revenue, but usually it's that lower middle market, the ones that frankly need help, and that's what we step in to really help them do that. With regards to specifically the M&A world, we've been on both sides of the table for many of our clients, depending on what they need to do, and those clients in transition, you know, when they need a stopgap measure for the CFO who left as soon as they heard the company was being sold, to whenever the acquirer actually puts whatever they have in place.
Thank you very much, Nelson. Winston, you're up next.
Hi, everybody. Winston Bragg. I am an insurance broker, both commercial and residential personal insurance, property and casualty. Although we are licensed to do life insurance, it's really just P&C. Target companies are revenues 5 to 50 million is really our sweet spot. On the commercial business side, on the personal insurance side, it's high net worth families, folks owning multi-million-dollar homes and so forth. I would say from the business standpoint and the M&A standpoint, we obviously get involved with respect to usually on the buy side with, you know, they want to look at the assets they're acquiring, are they properly insured, and so forth, inventory, product liability, but also the non-tangible assets such as media liability, websites, cyber insurance. That's a hot market right now and very necessary policy now. And so that's what we do, based in Westchester County, but I have clients in about 45 states. Everything from contractors and construction to real estate property management groups. We have a couple vineyards in California. Luckily, they've avoided the fires, and even entrepreneurs who have various businesses that we're insuring for them as well as their personal assets. So again, Winston Bragg. Name of the firm is Levitt First Insurance in Tarrytown, New York. Thanks.
Thank you very much, Winston. Joe Malizio.
Hello, everybody. Sorry for the delay. I was on mute. I am Joe Malizio. I'm the managing partner of Vishnik McGovern Malizio. We are a 18-attorney law firm in Lake Success, Nassau County. I do transactional work for the most part and exit planning and do estate planning for business owners as well. The firm is multifaceted. We have a commercial litigation area, marital area, transactional area with a commercial real estate arm attached to it, residential real estate, and commercial litigation. Good to know everybody.
Thank you very much, Joe. Darren Siafi.
Good morning or good afternoon, everybody. My name is Darren Siafi, CBMS Consulting Services. We provide advisory services to help firms grow. We're looking for those companies, you know, $500,000, you know, 4 employees or less, to help them get, you know, 5 to 10x in revenue. We help strategize, and we go from providing the basic bookkeeping services, accounting services, and CFO services, as well as advisory services. That's really where our mainstay is, in providing those advisory services to really help them grow, design their systems, and get them to that next level. Thank you,
Thank you,
Kyle.
Darren. Appreciate it. Jackie?
Hi, Jackie Grenay. It says Tab and 7-Star HR. I do have a couple companies, but I'm talking about the 7-Star company here. We are a full-service HR company. We serve generally from 10 to 150, sometimes with outliers on either side, employees, size nationally. We have, when I say full service, we have everything from a fractional HR option to an alternative method of hiring for small businesses. We also do training and projects, that kind of thing. We're agnostic as to industry and location. What we deal with in the M&A area, we do a couple things pre-sale. So we will do an HR MRI looking at the history of the company being purchased and their compliance situation to make sure that there aren't risks there, or what those risks might be, so that that could be negotiated in the deal price. We also assess the culture of the person being purchased and the potential loss of employees based on that culture. If you, after purchase, we will work with them on integration. So what we do is represent kind of the soft part of the sale. So sometimes I've worked with attorneys and accountants who are trying to get the deal done and been brought in because the people part of the sale is getting amok. The family business interaction, the partners aren't getting along and agreeing with each other. So I will help coach them through the process so that we don't get hung up on the deal for those reasons.
Thank you very much, Jackie. And Winnie, you're up next.
Hey. Hello, everyone. I'm Winnie Benjamin. I'm a business performance advisor with Stewardship Masters International. I'm the founder. It's a white label company. Our sweet spot is being able to work with sellers, potential sellers, building businesses, optimizing them with their employees. And what we specialize in the optimization process is helping those employees to embrace the vision of the company, of where it's going, and its new possible owner. At times we find out that there is a challenge, and those of you in the merger and acquisition realize that there are times when the employees become disgruntled, that their business is getting ready to be sold, and they choose to hightail it out, creating a problem for the buyer. So on the buy side, I help the buyer have that relationship with the new acquired company and talent. And sometimes the buyers are very appreciative of that because they don't know how to introduce themselves effectively to inspire the new talent so they can hit the ground running. So that's pretty much where my sweet spot is. I'm pretty much on the smaller side of the business, but we are also entering into mid-size by working with the Eminae team. So when I do get a big deal, I bring in my Eminae partners that's here so that they can take over and run with it. Thanks.
Thank you very much, Winnie. And I believe Daniel's having some issue with his mic. He's going to try dialing in. So if you can work around that issue there, Dan, we'd love to kind of hear your story. If not, just and put your information in the chat. So welcome each one of you to our roundtable today. Our spotlight speaker is Doug Rowe. He's a partner with Sir Tillman Ballin. He's a good friend of mine, trusted advisor, and he's an expert in labor and law. Doug, I have your profile up here. I mean, it's pretty extensive. I mean, most of the folks know you and your background and your company's track record. You know, one of the largest law firms here on Long Island. So we're interested to hear more about your topic for today. And I don't believe a slideshow or anything, Doug. So I'm just going to minimize the screen here so you can kick it off. But thank you for taking the time to speak and share your insights with our group here today.
Okay. Thank you, Kyle. Just a little about the firm. It is the second largest law firm on Long Island. Among our practice areas are real estate, corporate, trust and estates, bankruptcy, commercial litigation, and I concentrate my practice on labor and employment law. So, you know, typically we represent employers in defending wage and hour lawsuits, discrimination claims, restrictive covenant litigation. We also get involved on a consulting basis. We're brought in to, you know, review employment practices. We're brought in on doing due diligence on M&A deals. And, you know, part of my presentation today is, I'm going to start with a little bit of a case study and then segue into, you know, some of the issues we typically come across in M&A deals. So recently we were brought in to assist on performing the due diligence for a $700 million acquisition of a private Canadian-based company with extensive offices in the U.S. And, you know, we were, again, part of a team. I mean, there were 15 to 20 lawyers involved in doing the due diligence. So we reviewed, you know, pending litigation. We reviewed benefit issues. We reviewed employment contracts, employee handbooks, and we had to give advice on, you know, how these, and by the way, and also employment practices, and we had to give advice on whether these issues would have a material impact on the purchase price, and, you know, whether the purchase price should be adjusted based upon, you know, our findings. So again, you know, I work hand in hand with my corporate department here, which, you know, regularly handles M&A deals. So again, you know, you talk about the topic of employment law issues. So I'm just going to mention what we typically will be faced with and what we will address in the context of an M&A deal. So first of all, easily enough, we start with human resources policies. What is the pay practices? Does the employer pay overtime? We'll actually get involved to some degree on reviewing payroll practices to determine whether the employer correctly pays, you know, overtime, because, I mean, that is to not pay proper overtime in a larger company is literally a ticking time bomb, because at any given time, employees can go back 6 years and they can assert the claim as a class action, and we handle those class actions, and oftentimes, you know, it's an indefensible position. So in the context of an M&A deal, it's important to know whether the purchaser is going to be stepping in to a ticking time bomb situation. And by the way, you know, typically when we get involved in, you know, M&A deals, and anybody who's been involved is aware that, you know, purchasers can protect themselves with indemnification agreements and, you know, holdbacks and what have you. But there's actually case law in New York State, for example, that says indemnification agreements can't be used to in the context of a Fair Labor Standards Act, and by the way, a New York Labor Law Act claim. So, you know, the purchaser can't necessarily be comforted by the indemnification agreements in these deals. So it's important, again, for the purchaser to know what they're buying when they're with respect to the payroll practices when they're buying you know, another company. We'll review, as I said before, the employment agreements. We'll review the existing claims by employees, whether there's any pending litigation, whether there's been prior litigation, because that could reveal potential issues for a purchaser. Other potential claims we'll come across, for example, we'll get involved. A high rate of employee separations, for example, could be a sign of other issues within the organization. One of the big issues, which most attorneys and business owners will be aware of, is from a wage and hour standpoint, exempt versus non-exempt employees. A lot of companies believe that merely because they pay an employee on a salary basis that they're not entitled to overtime. And the mere fact that an employee is called a manager doesn't necessarily mean that that manager is exempt, because you have to do an analysis of whether that so-called manager is actually performing exempt duties. So we'll get involved in analyzing whether the seller has properly classified their employees as exempt or non-exempt. We'll also do the same analysis, by the way, with respect to independent contractors. Again, that's a hot issue, because if an employer has misclassified an employee as an independent contractor, that has the potential to create substantial liability for the seller, and as well as for the purchaser, potentially for the purchaser. We will review. I touched upon the overtime issue and the payroll practices issue, but aside from whether an employer properly pays wages, is also the issue of whether they properly track employees' time. Do they have a time clock? Do they have some system to track the time? Because if they don't, again, this could lead to other wage and hour claims by an employee or by a number of employees in the context of a class action for failure to pay all the wages for all time worked. Another issue we get involved in from an M&A standpoint is if the business that's being sold is a union employer, we'll get involved in reviewing the collective bargaining agreement. A lot of those agreements will contain successor and assigns clause. The employer, the purchaser, will have to be aware that they may be stepping into the shoes of the seller and may and will have an obligation to negotiate with the union, but also may have an obligation to adopt the existing collective bargaining agreement with the union. So we'll get involved in advising on the union issues relating to M&A transactions. Also, with respect to an M&A transaction, if a seller is a union company that pays into a multi-employer pension plan, the sale of the assets could trigger withdrawal liability unless the sale is done correctly in accordance with an established federal statute. So what that means is that if the seller sells and doesn't comply with this statute, then that could trigger withdrawal liability. And withdrawal liability just generally is that if a multi-employer pension plan is underfunded, which means that based upon actuarial analysis over some period of time, the pension plan is going to have to pay out more than the assets that exist in the plan, then any employer that withdraws from that plan has to pay withdrawal liability, even though they may have paid every dime to which they were obligated to pay over the course of time. So again, the sale of assets could trigger a withdrawal liability, and that creates an issue in the context of an M&A sale, because actually the buyer as well could be potentially liable for the withdrawal liability. So that's an important issue. And we addressed that also in the $700 million transaction that we got involved in last month. We'll get involved in reviewing employee records and status. We'll do a mini audit to determine whether the employer properly is in compliance with all the records and requirements. The I-9s, for example, every employer has to have every employee fill out an I-9. We'll review those to see if there's any potential contingent liability for failure to properly complete and maintain the I-9 forms. There's oftentimes an issue in the context of a M&A deal as to whether there will be layoffs in conjunction with the sale, and if there are, that could trigger WARN Act obligations. The WARN Act is a law, and by the way, there's a federal WARN Act, and there could be a mini WARN Act. For example, New York State has a mini WARN Act, which requires advance notice of a mass layoff, and if that advance notice is not given, then the employees would be entitled to severance pay for anywhere from 60 to 90 days, depending on whether the state or federal law applies. We'll review we'll get involved in executive comp issues to see if any of the M&A transaction will trigger any liability from that. Oftentimes, there are change of control provisions, in executive employment agreements that could come into play in the context of an M&A transaction. There are also, and there are other, so these are sort of the basic liabilities that everybody thinks about in the context of a sale of any business, but there are also hidden liabilities in the context of of employment law. So there is successor liability, for example, which means that if there is, whether there's pending litigation or not, if there's a discrimination claim, whether it's in the context of a pending lawsuit or hasn't yet been brought, the purchaser could have successor liability of that discrimination if they were aware of the discrimination claim.
And Doug, it doesn't
Yes.
matter if it's stock or asset, right? That successor liability transfers
Yes.
to the new owner.
It doesn't matter. Hidden liabilities, this is an interesting one, Kyle, and I don't know if you've ever come across this or if anybody's ever come across this, but if there's a sale of a business and this is on the unemployment insurance side, and the seller has a high experience rating, if the New York State Department of Labor will oftentimes treat the buyer as assuming the seller's high experience rating. We've had this issue several times, and it creates potential hidden liability for a purchaser, because the purchaser was operating as if they had a low experience rating, and all of a sudden they're stepping into the shoes of the seller with a way higher experience rating. We've actually tried to address this in the context of whether the tax indemnification law provision in the APA covered this scenario, but it's just something to consider also in M&A deals. So, this is a broad brush.
Doug, how can that be? What would your opinion be or suggestion be for a buyer that's walking into a potential scenario? Do you dig that deep and review their current unemployment rating, or no?
Yeah, we'll get involved. We'll get involved in that. We'll try to structure it in a way that the Department of Labor doesn't view the purchaser as having stepped into the shoes of the seller. But if they do, it could be addressed in some kind of indemnification language. But, it's an important issue to be aware of, and it's really, it really is rarely, addressed directly. If it comes up, as I said before, we try to address it in the context of a tax indemnification language, but it may or may not apply, and that could create litigation on the issue.
Of course.
So again, this is a high level, employment law issues in the context of mergers and acquisitions, and as I said, we get involved in these issues on a regular basis.
Thanks, Doug. Pretty good overview. You covered a lot of issues that come up as far as M&A related deals as it relates to employment law. I want to throw back out to the group. I don't want to pick anyone out, but I think I am going to pick some folks out here. I would like to have some feedback from Jackie and Winston, and anyone else has any comments or questions based on Doug's presentation.
So he's right on. So
thanks, Jackie.
It's as simple as that. The hidden costs of having these issues come back to bite you if your indemnifications are not correct, or if you don't know that the person that you're buying has these problems, is absolutely can be not only costly, but if you're trying to put the new organization together and get it moving forward, and you're taking time messing around, sorry, Doug, messing around with legal stuff, then it's a big issue for you, because you want to be focusing on moving the business forward. So now it's something that is really, really important to do as part of any M&A purchase, to know what it is you're buying, right?
Right. Jim, I want to get you in the conversation and Meredith as well, from the financing. Does the bank take into consideration that I'm talking most about the high exposure, high experience rating? If we have an unexperienced buyer that's buying a company, does the bank factor that into the loan or no?
Yeah, we want,
Could that affect working capital, correct?
No, it could for sure. I mean, we want experienced buyers with good cash flowing businesses and putting them together and making sure they can transition in. But it certainly could, yeah.
Yeah, I would add to that. We'll do a search for prior litigation. So, to see if they've been through similar issues or clean them up with respect to any employment litigation. It's also a sense of looking at people's judgment and how organized they are when investigating some of these issues, and that they do come into play when making a credit decision.
And this goes kind of with what Winnie was talking about as well. If you can prepare in advance, the other thing is, the percent of time the business owner is spending in the business versus other people. And if you can, that's kind of a whole planning, get it organized in advance, so that you can get that person out and move the business into the new business or to the new owner.
And I agree with Jackie in that format, why a business advisor is so important to a company, because at times we are able to find all the hidden costs in our checklist investigation, because there's so much involved. And every time we get that problem before us where a buyer gets stuck with more than, especially if they're not dealing with a intermediary or with a professional company. A buyer will just go out and assume a company without the due diligence, and a good could go up to 10 years sometimes, or they just literally bankrupt the entire company eventually because of all of the hidden costs, litigations, and all of those problems. And we are trying to avoid that, bringing in advisors ahead of time who will do the due diligence, every hidden situation that could show its ugly head after the transaction is done.
Yeah, unfortunately, getting, as Kyle knows too, I know he tries to get them planning in advance and do everything years in advance, and that's our goal. But, you know, when you've got business owners who are sitting there saying, I am taking I don't want any taxes, I don't, you know, so they give up the 30, they don't want to give up that 30%, but they give up 5 times the earnings because they aren't doing things right. So there's a whole big mess with not preparing in advance, both from a legal standpoint, as Doug said, as well as from some of the soft skills, not getting right people on the bus, and the due diligence that Winnie was talking about.
Well,
So
Jackie, I want to oh, sorry, Andy.
No, go ahead, Austin.
Okay. Jackie, I think that point you made is excellent there, that sometimes it's challenging to help owners identify how much money they're actually losing when it comes to deal time by failing to address these items in advance. And that's one of the pieces that I walk through with people all the time, and essentially say, do you want a small cost or a big cost? Because you're not going to get rid of you're going to have to pick one at the end of the day. And right now I'm working on a particular case with a business where it was very apparent that everything that could possibly be squeezed in for tax deductions was being squeezed in, even if it wasn't completely legitimate. You know, I wonder if something else has been in the news about things like that. Anyway, so I digress. But the seller just didn't even realize, let alone like the potential audit risk that's there. But he didn't realize that assuming all of that goes fine and it's no big deal from getting caught perspective, how much money he's leaving on the table when it comes time to multiply his EBITDA for the transaction price.
Exactly.
Like every dollar you're saving you is costing you $4.
Like even more.
So I've seen companies that are great at growing organically, and I've also seen companies that are really, really good at roll up. I mean, they know what to do. They understand all of the issues. You know, they have a checklist, Winnie, you know, that they undertake, and you know, invariably the biggest expense is going to be people. And the economies of scale that you're trying to maintain, you know, to try to find the best people to do the job that you know needs to be done when there are multiple candidates coming in from multiple companies. And then there are companies that just stink at roll-ups, and they lose money on every deal. Invariably, everybody leaves. They're buying a book of business. They leave. It's a complete crap show. So you know, it's true that many M&A situations emanate from acute, you know, something happens
where you can't help it.
Right, and they want, and you know, as M&A advisors that I know have always tried to say, you know, you got to plan 5 years out and stuff, but there are those companies out there that have it down to a science, and they're the ones to learn from.
I think it's real important, though, something that Doug's talked about, which is the unions and the union dues and that whole mess that that the owners aren't really thinking of when they go through this. I've been through it with several clients, and they're like, well, I didn't know this, you know, and, you know, they can be on the hook for millions of dollars in the funding of the retirement.
Right. I want to get Joe, because he's so on both sides of this argument, right? I know Joe Melizio represents both buyers and sellers in corporate transactions. Joe, what's your take on the subject matter?
Yeah, so I think a lack of due diligence, as Doug has been telling us, is the most problematic aspect of a transaction, be it from the sell side or the buy side, because the seller is always looking to maximize, obviously, their return. Buyer is always looking to maximize the business opportunities, and sellers are at a disadvantage, especially when there's something like an earnout that comes down the pike, and they're expecting another influx of cash as part of or as ancillary to the purchase price or in addition to the set purchase price. And they often lose on that because calculations are done differently. There's a misunderstanding in the way the buyer might be calculating their income and expenses. And if you have all of your financials in proper order and both parties know what to expect, it results in a lot less angst and potential litigation down the road.
It's funny, you know, Robert Puerto from Burrison Bank Associates couldn't make the meeting. He's our resident CPA, and I'd like to get his input. And maybe Nelson, I'll probably pick on you a little bit because, you know, your taxes and your taxes and your day-to-day financial operations are always in conflict, right? You hire a CPA to make sure that you're not going to pay as much tax as you should pay legally speaking, right? So the whole process of that is to minimize your tax impact and as far as what you're going to pay. On the flip end, if you are in fact planning for a sale, there are some things you need to do on your tax return and preparation for that. And it may take 4 or 5 years because you don't want all of a sudden start making changes that could create flags. So Nelson, you wanna chime in on that a little bit?
Sure. I mean, I think you hit the highlights as it is, you know, balancing those two. You know, from our perspective, we're usually internal to the company and looking out for the company's best interests, but we rely on the CPAs and tax advisors for the tax strategy side. But to your point, we actually literally ran through that very specific scenario over the past few years with one client where one of the advisors who was working with them as well basically was telling them, if you keep going like this, essentially you're going to get hit with a 7-figure tax bill when you sell. So we want to set these things in place. And of course, the business owner refused to listen to them for 3-4 years in a row. And then when they did sell, they absolutely were hit with a 7-figure tax bill. And it was one of those types of things where we're sitting there explaining to him that, yes, you know, this is the effect it will have on the business, but this is what you should do because this is what you're trying to do in this situation. And we've all worked with those business owners where they trust us and they like us, but they don't necessarily listen to us. So it's
right.
So this is certainly one of those where they didn't listen. And then, of course, after the fact, then they were going through, well, how can we change this now? And I was like, well, that's why we told you this for the past 3 years. But it's one of those scenarios. Right. So it is that balancing act, to your point, Kyle. And working with the right CPA is a very crucial part of this process as well.
Mm-hmm. And George, I want you to jump in here because the labor issues is a big one that's overlooked, but intellectual property as well is a huge asset that a lot of companies actually take for granted, you know, as far as making sure they're registered, making sure they're protected. And when it comes to M&A transactions, sometimes depending on the asset and what's involved, the intellectual property has a lot to do with it. So
that's correct, right? So like Doug said, you have to go in and look at all the employment issues in buy and sell transaction and M&A, but also with the IP, you have to make sure that the IP is all bundled up. The company owns the IP. There may be instances where the company has a bunch of patents, but they never had them assigned to the company. The inventors are still the owners, and they're maybe way gone. Maybe they left the company. So you have to make sure all those patents are assigned to the company. and then also taking a deep dive and ensuring that the products the company is selling are protected by their patents and they're not infringing other patents. So you may get yourself into an infringement lawsuit after you buy that company. What we usually hear from the small companies, they say, oh, no, we've been selling this product for 10 years. That company never bothered us. We don't think we infringed because we never got anything from them. But it's because they're small, they're not really affecting their market share. Once a bigger company comes in and buys that smaller company, and the idea is you want to increase distribution, increase your market share, now you're going to have a lawsuit because now you're a target since you bought that company. So those are the issues we look for on the IP side. And like Doug said and Joe mentioned, we bring that back to the company and it's their decision. Hey, do I want to buy this company? Do I want to reevaluate the sale price based on these issues? And that's our job, is to find where there may be problematic issues and also untapped value, like when it comes to trademarks. If you are using a trademark for many years, you never registered it, it's not, doesn't take long to get a trademark registered. And now when you sell the company, that's an asset that previously you may not have on the books.
Thanks, George. Jeff, what do you see on the real estate side? I know you involve a lot of investments, Culkers, you have a lot of properties right on the market as far as development and so on. Long Island, you expand outside. You have investments outside of Long Island too, right? You have stuff outside of the New York area, or primarily in Long Island?
Primarily on Long Island. It's going to evolve over time. So we're most concerned right now about doing construction projects right here and raising capital to fund those projects. But the longer range goal is to do development outside of the area as well. Absolutely.
Mm-hmm. Got it. I want to hear a little bit more before we jump into the next segment. I want to hear a little bit more from Carl. I know you're involved in a lot, and what you do is pretty unique. I want to share some of the projects that you're working on with the groups, and folks can get a better feel for the type of work that you do.
Sure. So on the document side of things, we're taking a look at the intersection of documents and data and how it's so critical to get that information in the right area. So one of the things that's going on right now, our solution, we beat out 2 Gartner Magic Quadrant companies when it comes to the automation of mortgage certification for one of the top banks and the leading document custodian. And this is important because when you're taking a look at the mergers and acquisitions, and we're actually preparing a due diligence offering around mergers and acquisitions, we're saying, look, you're already gathering this information anyway. So why wouldn't you pass this through a system that could get you a little bit more insight, and where you could combine that with outside information and now really be able to establish the right type of context and the right type of risk management around that. So one of my clients right now is a cybersecurity company that has a capability to really plug the gap in the 60% of the Fortune 500s right now, or Fortune 1000, are really at risk for Microsoft updates and ransomware attacks. And they're happening all over the place. I mean, it's a really big issue. So all of a sudden, this company is now being courted by major tech companies, as well as a friend of mine who's put together a $250 million roll-up, and being able to pull these different components together. So one of the things that we were speaking about as they were looking at the candidates for the roll-ups were how when it comes to the valuation, a lot of people are taking a look at the technology and the assets. They're not taking a look at the people cost, and they're not taking a look at the post-integration costs afterward, which could actually devalue the transaction or flip things upside down and not allow you to get the multiples. I mean, we had a situation with another client. I helped restructure an aviation supply company supplying governments and militaries since the 60s, brought in a whole new team and some capital and some other components. And it was very interesting because that whole earnout piece of the equation came into question, right? In terms of the seller being able to maximize their value. And a lot of this came back to the documentation and then the ongoing data and being able to integrate some of those pieces together. So I'm listening to what everyone's saying, and I definitely can see how when going through this process, not only the documents and the data, but then the people themselves, what Doug had spoken about with the employment law and the structures, I'm curious as to how this gets affected or impacted now in the context of the California Consumer Privacy Act, GDPR, and when you have multinationals that are now moving in on the transactions. Are you guys, as the professionals in the M&A space, are you seeing this now add all different kinds of complexity into the deals, from the IP holding structures into, you know, the literal transfer of the assets that are taking place?
George, you want to take that one?
Sure, I can speak to the IP. Yeah, we've seen transactions where the owner of the company is looking to sell, and he's like, I'm going to put all the IP in an IP holding company, and then I'm going to keep that to myself and license it to the new entity. Sometimes it works. Sometimes the new entity doesn't fly. They want the IP rolled into the transaction, and usually, if it's a technology transaction, they're buying the company because they want that particular piece of technology. They want to own the IP. But sometimes there's companies that may have a separate IP holding company, and when they go out to sell, they say, I'm selling the main operation. The IP holding company is not being sold, and they get people who are interested in just buying the operations and licensing the IP, or maybe saying, I'm not interested in the IP, I'm going to develop my own IP. But the trademark is usually the key. If you're buying a company, you obviously want to, if there's goodwill with the name, the company name, you want to have the trademark and being able to be part of the transaction. So that's usually the wrinkle. Sometimes the company says that I want to keep the trademark to myself and license it out to third parties. That usually doesn't work that way. You want to own the brand, the goodwill that comes with it.
Mm-hmm. I mean, a part of the due diligence, we try to get as much information up front, and part of it is an IT due diligence as well, to see what the technology infrastructure, what's involved, and want to make sure that we understand the full dynamics of the company before, because the buy is going to be uncovered at some point. The buy are going to find those issues, so you want to be able to address those up front. And you mentioned the GDPR and California stuff was happening out there. I mean, this is a little bit newer for some companies. It affects some more than others, and I think over time it's going to be more common practice to include as part of the due diligence process. I want to transition. I don't know who it is, but someone had submitted. We sent a survey out before our meetings, and one of the topics that I got back, or the ones I picked out from, was if you guys can see it in the chat, it's reducing seller revenue risk post-transaction, where a buyout over time is involved. So essentially, this is a case where the seller sells a company, and I'm assuming it's an earnout based upon this particular topic that was submitted. And this is a pretty big issue. I don't know who was it that would like to volunteer to actually submit this particular topic, but anyone has any feedback? I think, Joe, do you want to take this one, Joe?
Yeah, sure. So as I alluded to before, earnouts are famously subject to disputes between the buyers and the sellers, because each one has their own respective understanding of what they're entitled to or what they're obligated to provide. So it's very important that in the transaction documents that the earnout is defined very specifically, so that both sides are in agreement on how the earnout calculations are done and what they're looking at from an income and expense ratio to determine what the earnout is going to be. And sellers have to be honest with themselves also, so that if they are taking those huge deductions for personal items, things along those lines, they have to realize that it's going to affect their future earnout ability as well. So they have to take that into account. And I think the largest help that I've seen a seller in this area is for the seller to remain within the operation for at least the earnout period, so that the seller has the ability to maintain customer-client contact, has the ability to look at financials, see what's going on with the operations, after the buyer takes over to essentially protect the seller's needs. So some people say, hey, I want out, I want to sell this business and I'm done. But that's not in a seller's best interest when it comes to post-closing consideration.
Yeah, I agree 100%. I mean, if you're selling a company and someone owes you money, you want to be in the kitchen when the sauce is being made to make sure you can actually, taste the sauce and make your own sandwich or whatever, right? So we recommend it as well. And Joe, you're right. That earnout should last the period of time that the contract, the employment contract for the seller should actually be consistent with the time for the earnout. Carl, you have additional question on the topic?
No, I had asked this question.
Yeah, I mean, it's an interesting one because to that point that Joe that you just made, I think that's actually one of the greatest disconnects we very often see with sellers is they think that the business is worth what it is on its own without them. And that disconnect between their personal value, their connections in that place, that actually drives a lot larger part of the company value than they initially think. So it's in that earlier stage when they're thinking about selling it is how do they set things up so that they are not as large a percentage of the actual revenue drivers because to your point is once it actually transitions and then it's like, well, they're not as involved or it's a new company and they're not there, then that's when the revenue starts going down.
Right. But it can be structured in a way that the earnout can be paid off either quicker or it can be mutually beneficial.
No, it can be structured that way. I just very often find there's that disconnect in that seller where they think the company is worth more on its own without them, as opposed to they all know it instinctively perhaps, but when it actually comes down to dollars and cents of it, there's very often I find the disconnect.
That's why the company.
Kyle.
That's why the companies that develop process and from the early on stage and document everything and then empower their people properly, they're the ones that reap the bounty later on.
Yeah.
Kyle, I see it the other way though, and I represent the soft side here, right? Not those kind of financial things where the owner no longer has control of the employees that used to work for him. They're being directed to do things totally differently. And so that's a risk also, depending on the culture of the new firm and how, if they're buying I've seen it over and over again, a big company buys an entrepreneurial company, adds all of the processes and the things, the big company things, and almost kills the small entrepreneurial company that they bought because they're not able to move as they were able to move before. So.
Mm-hmm. And I want to get Meredith and Jim in here to talk on the financing component. And Meredith, if you don't mind going first, and the deals that you're involved in, do you do it? Give some more context about your financing arm. I know with the SBA, the owner can only stay involved for, I believe it's 12 months on the SBA side, which Jim is going to talk about. But for the type of transactions you handle, explain how this works post-transaction with the seller staying involved. That's collecting on the earnout.
We're agnostic to who stays involved. We really just care about where the assets are. So if there's enough assets post-transaction, we'll lend the capital for the actual transaction. We look to how much accounts receivable they have, for example, and then apply an advance rate to that, basically like 85, 90 cents on the dollar to that. Same thing with inventory, machinery, and equipment at different rates. But we don't get involved in running the business at all or any strategic decisions. It's just a passive working capital line. So we can step out of the way and post-transition, they can do what their agreement calls for.
And you're a direct lender, correct?
Direct lender, yes.
Okay. Jim?
Yeah, so the SBA does have policies on how long a seller can be involved for, and it's 12 months. Earnouts per se are not allowed in SBA, but they're structured. We structure them as performance-based seller notes. So you can have a seller note for any amount of time, and then it's structured based on whatever you're trying to tie the performance to, whether it's revenue, EBITDA. Sometimes there's a customer concentration, and you tie the seller note to maintaining that customer at some level. So there's some creativity to it, but the SBA does have some restrictions on earnouts or post-closing revenue.
Mm-hmm. Thanks, Jim. Winston, I want to hear from you. I mean, the insurance piece is a huge one as well.
Yeah.
Either from the property, even from the personal and employee benefit side. So you have a buyer that's taken over a company. The rates, you may not have the same rates as the seller. And so you want to talk about, the topic here is post-transaction. So if you want to explain, if you're representing a buyer, what's involved from the due diligence during the deal,
Right.
and through post-transaction.
Yeah, I mean, we don't get involved in so much the economics of the deal, but obviously on the buyer's side, part of the checklist due diligence is to make sure that what they're acquiring is properly insured, as well as to make sure if they're retaining personnel that they have errors and omissions policies, D&O for directors and officers, and so forth. But if there are, outstanding claims, they need to be aware of that. It could be anything from a workers' comp to a workplace harassment claim. Even Carl touched upon it earlier. Cyber's a big deal now and very real, and it's no longer a nice to have, it's a must-have policy. You see the headlines almost every week. Big companies, small companies. That's kind of a misperception. Small companies feel like they're not going to get hit, or they're too small to be hit, and that's just not true. It can result in the shutting. If you're the seller, there's a reason to have it. It can result in, the business being paralyzed. And if you're in the midst of selling your business, that's could be a deal breaker. So you want to have cyber protection there, especially too if you're on both sides of the transaction. If the company is doing transactions over the web, e-commerce businesses, retaining customer data, credit cards, personal info, etc. So, but on the physical assets, yeah, you want to make sure all the properties are properly insured. Management liability, I've got a hedge fund client who's the investors wanted his limits increased before they invested in his funds. So, all the scenario, there are many different scenarios, but insurance is a big piece of the due diligence, and there's several boxes to check, both the buyer side and the sell side.
It's funny, we were involved in acquisition. We acquired a HVAC company on behalf of one of our clients, and it actually had a two-year note. My client was the buyer. We were on the buy side in this particular transaction, and my client couldn't wait to get the sell out of the picture. So she ended up paying him off early because this is a disruption to the company. He refused to kind of let go. Like, he said he didn't own the company anymore, and he still wanted to run the company like he owned it, and was actually affecting the staff and the mechanics and so on. So I don't know if Winnie or Jack, you talk about that, because I mean, it's tough both on the buy and the sell side. There's a lot that's going on from the employee and the management and from the CEO level, that you need to have someone to educate and coach both buyer and seller what's going to be involved post transaction.
Yeah, so absolutely the integration, and given we often will do behavioral assessments, so we can look at how are they going to try to interact with each other, so they understand going in that somebody who's high driver trying to get the business where it's going to go is unlikely to like to do what someone else wants them to do. They were a boss for a reason. So and I think that needs to be understood when you're putting the deal together. And I often see that the person saying, I'm going to stay in for 5 years and collect a salary, and it just never works out that way. It rarely does it work out that way. they can't stand it, and the person that bought the business also can't stand it.
You know, we've seen that happen multiple times. We need anything to add?
Well, yes, and that's why nipping it in the bud early in the game, one of the things that I believe NYBB will be doing is to offer such workshops for buyers, you know, owners of companies, and so that they, and sellers as well, together to understand the dynamics of here you are leading, and when the situation change, be willing to drop back and let the other one move forward. And at times, this is what happens when you're developing leaders. They are growing, but they're not really growing. They're not understanding the dynamics that you go to a certain point, then you drop back and develop others under you. So at times, the value that I would see with a company would be if the person who says, well, you know what, I'm going to stay on because it's part of the deal. I'm doing that so that the staff, the talent that you're acquiring will take a lead from me and be able to stay on and admire how I allow myself to be led and how I work with a new buyer. And at times, that's when they get the message, you know, that you're not doing it for you, you're doing it for the talent that is now going to be acquired by this new owner. And the business owners that stay on and they realize that it's just a sweet deal. But like Jackie said, is it easy? Heck no.
Heck no. And you know what? If there's a buyout involved, it makes it even worse because they've been doing it this way to achieve the goals. And now they're screwing it all up, they say. And it's going to affect my buyout.
Right.
So that's the other issue.
Yeah, they got to be trained early.
Andy, I want to get you involved here. You do a lot of marketing and branding, and I'm not going to talk too much. I want you to talk about branding, but a lot of things, what I see from the acquisition side of things, a lot of times the buyer wants to come in and change the whole format. They want to change the name, change the concepts and everything, and they fail. They fail at that as far as retaining the goodwill in the company they acquired. Can you talk more about that aspect of it, the marketing strategy? So you just bought a company. How would you look at that from your perspective in retaining the goodwill and asset you acquired?
So, I mean, so look, the question is, what are you buying? Are you buying, you know, the best companies in any sector, you know, geographically, in any vertical? They're the ones that have a brand that is almost robotic in nature. So you take, like, for example, Doug. Doug, you know, your firm is automatically included in most transactions that involve your specialty. So it's almost like you never get fired from hiring GE. Well, there are certain GEs in every geography, in every vertical marketplace that just have to be included so that you can explain to your boss, well, I did speak to them. You know, I put them in the mix. So, you know, that kind of brand and that goodwill, you know, if you have that in a transaction, what is that worth in the transaction? And I mean, most everyone on this call is a money person dealing with numbers. And so brand is kind of an abstract, and goodwill is a kind of an abstract concept. But then again, you look at Google, and on Google's balance sheet, you know, their brand is worth $669 billion, and Coke's was worth $40 billion for years. It was the most valuable part of their balance sheet. So if you're buying a company to buy a book of business, or you're buying talent, or it's a strategic buy that you're actually adding products and services into a mix, and you feel that you can leverage what you already have to take advantage of that, that's one thing. But if you're buying for a brand and then you're trying to dismantle that brand in the company, I mean, you're shooting yourself in the foot.
Exactly.
So why not just take it for a ride? And even if you have to keep it separate from your brand, you know, do it. I mean, test it. See what's out there and see how strong it is. Does that kind of make sense?
Yes, absolutely.
Definitely.
Totally.
So, go ahead. Who was that?
Sorry, Kyle. Can I just add one thing in there?
Yeah, sure.
one of the companies I have an equity holding in does product placement in movies and TV shows. My partner actually had gotten vitamin water onto the set of Sex and the City. And Coke sped up their acquisition before that movie came out as a result, because they were seeing the traction that was going on. And we've also seen how you can actually list that as an asset on your balance sheet, as you had said, and have taken a look at product placement as a mechanism to being able to drive to the multiples of the valuation that you're looking for, or even on the M&A side with the family offices, being able to focus away from the transaction more toward the goodwill and the social impact side, and being able to create a valuation buffer and revenue buffer around the new products and services that are coming out from the merged company together.
Yeah, I mean, it's a very smart business person that truly understands the assets that they're buying. And somehow, as Jackie says, the assets are soft as can be, but very, very, very powerful. And so why not take that for a ride if you're going to pay for it?
I think it all boils, I mean, all the deals that we have done, it's never a company and a company. It's always a person and a person. Like we are in the people business, right? And even on the acquisition side, people are looking for talent. Talent is hard to find. And when you have talent, you have to retain them, train them, and find new talent. So the soft aspect of it, the people aspect, the human capital is often overlooked many times. Doug, I want to, have it go back to
one more comment, just real quick.
Sure, Andy.
I mean, you look at a stock analyst, and they're always looking at management and how management pivots. I heard the statistic, and then I'll pass it back to you, Kyle. Of the 100 oldest companies on the New York Stock Exchange, not one of them depends on the business that they started with. It's always management and process. That's what makes a company a company.
Amen.
Good point. I like that. We could close off with that right there.
Exactly.
Awesome. So as you wrap things up, we are approaching our 1:30 mark. Doug, any closing comments? We also want to circle back to you. Anything that you'd like to comment on?
Well, it's obvious that the importance of labor law compliance can't be underestimated, and it's equally important in the context of M&A deals. Just pointing out one more example of hidden liabilities. There's a law in New York that requires employers to pay their manual workers on a weekly basis. There was a recent court decision that said if employers don't pay their manual workers on a weekly basis, but pay them on a biweekly basis instead, they owe in liquidated damages, essentially over the course of the year, 50% of their entire salary for the year. Multiply that by 200 employees, for example, if that's how many manual workers they had, and multiply that for 6 years because they can go back 6 years. That's a hidden liability that is not necessarily going to be addressed in the context of the APA. So that's why it's that much more important. That's an example of why it's that much more important to do proper due diligence in the employment law due diligence in the context of M&A deals. Doug Rowe.
Thank you. This was a very fascinating discussion, Doug. I appreciate your presentation and what you presented today, and we had some good discussions that evolved around that. So I'd like to continue this. I mean, there's a LinkedIn group. If you bear with me for a second here, I'm going to put the LinkedIn group in the chat here. So just bear with me for a second. Be sure to join the group and connect to some of the other folks that are in this particular meeting in the group. Also, I'm going to send later on today, I have a pretty crazy day, about you might get it tonight. I'm going to send a contact list for everyone that's actually was in the meeting, because you always want to continue that conversation. We have these roundtables twice a month. We have a New York group and a Long Island group. So if you're interested in coming back, just reach out to me, and we can get you some information for when when is the next meeting. Let me just find the group here for a second. And next week, Thursday, be sure to register for our forum. So a lot of the stuff we spoke about today, we're going to discuss it on that particular forum, because we're going to have a buyer and a seller that went through a transaction, and you'll be fascinated to know all the pitfalls and that they have been through. So Andy has been very instrumental. He's part of our education committee and Winnie as well in putting this entire event together. So
Yeah, the original
I would
graphic
encourage you to actually register and
the
check it
original
out.
graphic was a Rock'em Sock'em Robot, so you really should.
Yeah, yeah. Well, I think I sent it to Doug directly instead of everyone. Hold on. Okay, so that's the link for the LinkedIn group. So you guys can continue the conversation there. So I want to thank you guys for taking the time to participate, and look forward to connecting you guys on our next roundtable. Okay.
Thanks, Kyle.
Thank you all.
Thanks, Kyle.
Thanks, Kyle.
Pleasure,
Bye-bye.
See
everybody.
everybody.
Take care.
Thank you.
Take care.
Thanks.